Good afternoon and welcome to today's Trader Planet Live webcast titled Spotting Breakouts That Lead to Trend Reversals. This is the latest in a series of live webcasts offered by Trader Planet featuring well-known industry experts. Today is Tuesday, February 16th, and we're happy to have you join us today. This is Darla Tuttle, and I will be your host for today's webcast featuring Daryl Jobman, a senior analyst for TraderPlanet.com. Today's presentation takes place at a specific date and time, and therefore any opinions given by our presenter may change without notice at any time. Trading involves substantial risk of loss and therefore may not be suitable for all investors, and past performance is not indicative of future results. This webcast is being recorded and will be archived on TraderPlanet.com, so you will be able to review the material at a later time. You can also find additional previously recorded webinars among our other free educational resources within our site at www.traderplanet.com. Our acclaimed presenter, Daryl Jobman, trades his own personal account and has been involved in the financial markets for more than 40 years. A decorated Vietnam War veteran, he has served as the editor for several agriculture publications before becoming an editor of Futures Magazine for more than 15 years. He has written and edited more than a dozen books and trading courses on trading. While his mission is helping others succeed by learning the do's and don'ts of trading, his editorial contributions to Trader Planet have really permitted him to amplify this passion through the interaction with our members. We're pleased to have him with us today. Let's give a warm welcome to Daryl Jobman.
Thank you, Darla, for that introduction. Before we go too far here and get into the subject at hand today, we're going to do an audio check first. You will notice at the lower left-hand side of your screen, there's a little man with his hand raised. There's a menu there, and if you would click on that little arrow there on that menu, and if you can hear me okay and the sound's coming through and everything is satisfactory with the audio, would you please click on I agree? That'll give me an idea who can hear, and if there's any problem, obviously you won't be able to hear it, but if you can hear me, just click on the I agree sign. Okay, we're getting some people that can that are indicating they can hear me okay, so we will assume that that applies to almost everybody out there, that they can hear me okay. I want you to keep an eye on that little man throughout, because we'll be talking about a couple of different occasions where we're going to use him. Now, the first one, let's just do a little practice, and let's just ask the question, I am a trend-following trader. Now, if that's you, if you're a trend follower, click on I agree. Doesn't mean that you have any particular type of thing, but if you're a trend follower, you like to follow trends, I agree. Okay, looks like most people tend to be trend-following traders, so we will go on that assumption. Of course, that is very important to the subject that we have at hand today. Also, want to mention, as a housekeeping type of thing here, is that we are using the data provided by CRB. CRB has been around for a long time, probably longer than most of us have been trading, so they have quite a historical track record. And a couple of other items, if you do have any questions during the time, just kind of make a little note of them in that little chat box at the lower left of your screen, and I'll try to get to the questions at the end of the presentation. And I can't always see the questions as I'm going through, so reserve those for the end. And then secondly, when we do get to the charts, you might want to flip your computer over to full screen mode, because there are some points that I will be trying to point out as we go along, because that might make it a little bit easier to see. Well, today's subject of the webinar that we're doing today is breakouts. As I mentioned, everybody needs to know the trend first. That's a very important, basic trading skill that you need to achieve. A lot of ways to find out what the trend is, and we'll just talk about a couple of them as it relates to the breakout type of situation. Of course, you have your trend lines, uptrends, downtrends. You have trend channel lines, sideways range, a lot of different ways that you can call a breakout type of a situation when you are trading, and what you look for as like support, what you look for resistance, all those types of things. Just to look at it on a chart a little bit and give you some idea here of what we can see on a chart. Of course, you have your trend lines. Where does that trend line go? Is that the correct place for the trend line? Is this the correct place for a trend line moving up? Is this the correct place for this downtrend? A lot of factors go into what makes a trend line and what is its value. Very subjective sometimes in terms of where you want to place that trend line. Now, also, as you are noticing, you will see that we obviously have some highs and lows that we consider. When you get into the highs like we have had here, this is a gold chart, happens to be, that's a high that everybody's going to shoot for and think that that's a target, a potential target. We have a high here. Are we going to get a breakout of that? Is it going to be strong resistance, keep us from going up? We have the lows. These kind of points here are all important points in terms of talking about breakouts. And then you have your other formations. You have your little formations that occur, during the moves. When it goes up, you have a little situation here. You might call that a flag. You have some other ones that you might put in here. You might call this a triangle or a pennant, whichever. And then breakouts of those suggest certain things to certain traders. And of course, when it comes to moving average lines, we have breakouts of those. You have breakouts of the market is going to respect those pivot points and then turn back from whatever that point is and stay within a certain range throughout. Now, one of the things that we have, as I said, we have a lot of different possibilities here that we can use for breakout criteria and what constitutes a breakout. What we typically have, though, is some very subjective types of things, like as I mentioned with the trend lines, support, resistance. Sometimes what you have is you have a point where you know that this is a previous high, and what the market will do, specifically markets like grains or so forth that have a time when they don't trade in the morning, like after a crop report, when you have the prices jumping across, gapping those points, the predicted or the previous highs, previous lows, whatever. So you kind of get a little bit of misleading information when you look at that. So what I've done is I like to look at another type of way to build myself some kind of a channel and use that as a point of reference from which to trade. Now, when you look at the channels and other types of things, I mentioned channel trend lines before. Again, those are subjective, so I'm going to go for some more specific price points. And in this case, I am using Vantage Point intermarket analysis software. Now, one of the first things I need to make clear is that I'm not a salesman for Vantage Point, and I'm not selling the product. I'm not getting money for selling the product. But I'd like to develop some trading strategies and see how they would work. Using a particular type of software, and Vantage Point happens to be a tool that I found to be helpful. When we look at Vantage Point data, we are looking at a series of data that is based upon intermarket analysis, the influence of markets on each other, on a target market. A neural network process determines the 25 markets that have the most influence on a target market, and then they reflect that influence to the degree of which the target market is being influenced in a set of intermarket data. When we look at the predictive indicators that we're going to talk about from Vantage Point, we are using typical prices. That's the average of the high, the low, and the close. Most analytical software, most indicators use only the close as their price point, but computer analysis has determined that typical prices are more useful for forecasts because they take into account the whole trading range for a day and not just one price at the end of the day. So when you look at the influence of the other markets, the neural networks forecast price direction. It's not a long-term forecast. You're not going to be able to look ahead and say, okay, this is the point at which we are now going to trade up forever or down forever. But this is a short-term forecast, and that's the most that we can expect to get, just as you can expect when you're looking at weather, for example. You don't get forecasts typically that will work for long-term. You have to kind of keep the short-term in mind, what is going to happen in the next few days. The chart that I have up here now is that 6-month gold contract that we used earlier. We'll talk about a couple of indicators. First, I need to set up the type of trading I do with the breakouts with a couple of other indicators that are on here. The first ones that I'm going to add, I'm just going to add a series of different types of indicators here that Vantage Point has and talk about them a little bit first before we get into the breakout type of situation. With the Vantage Point screen, we have several different indicators, and we're going to talk about each one of them in turn. We have the predicted moving average. This is a predicted medium-term moving average, which is that blue line, and you see that is going to be compared with the actual moving average, the simple moving average of the close, and that is that black line that you see there. When you look at these obviously you can see where the trend has changed. Sometimes these moves are a little bit long term. I mean, it may not be particularly precise enough for what you want to trade, but we'll look at a couple of different points here that we can look at for the crossovers right here. Obviously the market moved up there, and then you have to wait for this move to continue. We have the situation over here where the market moves down. So you do have the moving average crossovers, very useful, very popular for a lot of different types of traders. To help determine, whether this is a valid trend change or not, there are a couple of other vantage point indicators. The first one we're going to talk about is the neural index. The predicted neural index is a comparison of two 3-day moving averages. In 2 days, will a typical price be higher or lower than it is today? If a forecast is higher, you're going to have a reading of 1. If it's for a lower typical price in 2 days, you're going to have a reading of 0. There's no in between. It's either up or it's down, correct or incorrect. That's the value of the short-term indicator that you see with the neural index. Again, it's helpful for getting into the market, primarily getting into the market on a short-term basis. I pointed out this plot right here where you had the turnover. Another very useful feature of the Vantage Point software is the predicted differences. The blue line and the green line on the bottom that you see are the differences between moving averages. The blue line is the comparison of a predicted and an actual or a regular or actual moving average. That's a medium-term one. The green line is for long-term moving averages and comparing them with each other. And then you have the crossovers, which is a good leading signal that the trend may be about to change. There are a couple of other features that you'd like to watch when you're looking at the predicted differences. One is the angle of the lines. Are they moving up, down, sideways? Secondly, you also want to know where they are relative to this 0 line right here. Are they above it or below it? Effectively, what the predicted differences serve as a function of the momentum indicator. There are stochastics and there are some others that are that measure the momentum. How strong is this move as it's moving up or down? Is there a lot of strength in this move? Is it worthwhile trading this move? That kind of thing. And so you want to have some corroborating evidence from your other indicators if you're going to signal. You need that evidence from the other indicators to indicate to you, what you want to do and what position you want to take. Now, as you're looking at the indicators and trying to determine what to do, you also need to take in rather subjective. It's kind of like you look at it and you don't really know for sure at what point you want to actually put your particular stop to buy or enter or whatever to get out of it. So what I'm going to do here is I'm going to add another one. Now, this is going to add a little bit of a element to the screen, and I hope you don't get confused by a couple of different lines here, but it's important as you go along to look at these lines to see how they relate to each other and how you might be able to trade these lines. Now, what I'm going to do is I'm going to take out the medium-term crossover line, that blue line and the black line there, and just cut straight to the predicted highs and the predicted lows. Predicted high is the gold line or the orange line. The predicted low is the pink line. That is forecast 1 day ahead. It provides a range in which the market can be expected to trade. Again, a probability. It's not like a guarantee that it's going to be there, but it is a probability of what could happen. Now, to get a little bit closer look at this, we're going to cut our dimension down to 2 months instead of 6 months and talk a little bit about it. Again, about gold, just kind of as you recall from the longer term chart that we looked at earlier, since the high that we had, I believe it was in January, or earlier when we had the high above $1,200, the range of the market has, or the tendency of the market has been generally down. So we're looking at overall the trend down. So you want to keep in mind, there's always about 3 different trends you got to keep in mind when you are looking at a market. One is what's the big picture, the long-term outlook. Is that situation, going to be the most important, or is it going to be first primarily to the short term, the medium term, which is kind of those little swing trade types of situations, or the very short term where you have the day-to-day fluctuations that would be more useful to the day trader or the intraday trader. In the case of gold, we're going to look at a couple of situations on the chart and talk a little bit about some of those as to how to use the breakout of the predicted high and low, that range, to determine where to get in and where to get out of a market. We're going to start right at the first of the year. There are some other points we could talk about earlier, but we're going to start at the first of the year with January 4th. On this particular day right here, the predicted high can jump down, they can fake you out, they can penetrate something. There's a lot of jabs and so forth that you want to protect yourself against. So what we're going to do is we are going to establish kind of as a little bit of a leeway for us and try to avoid those types of situations. We're going to use a $10 leeway before we're going to get into the market. In other words, it has to exceed the predicted high by $10 before we're going to enter the market. Just give it a little room to breathe if it wants. In this case right here, that means if we were doing this, we would be getting into the market at 1113. That's the predicted high, 1103 plus 10 at 1113. Now, there are various ways that you can trade once you get in. As you probably are aware, if you have traded gold, the margin or the performance bond, as the industry prefers to call it, for a full-size gold contract is something like $6,700, which makes it pretty rich for anybody who has a relatively small account. So you may want to be looking at the mini contract, the 1/3 size contract. The margin of the big one, $6,700. The mini contract is more like $2,500. I don't know what the exact latest performance bond is for the mini, but somewhere around $2,500. And the reason I'm suggesting the mini is because with the smaller accounts, you want to be able to have some flexibility and ability to get in and out, just kind of like the big boys do. If you have a big account, you don't have to worry about it so much, but you want to be able to get out at certain points and to set up an account, or set up a trade rather, that gives you that opportunity. In this case right here, we talked about getting in at 1113, and again, we're going to set an arbitrary target. We're going to say that if I get a $20 increase in profit, I am going to take some profits on at least one of the 3 contracts. I'm going to be trading in 3 contract multiples. So that puts your target at 1133 for the first target that you would get out of those 3. Now, this one was hit on January 6th. That was hit. And you had $2,000 that you had in your pocket from at least one trade. If nothing else happens, you at least have some money. I know there is a maximum in trading, let your profits run, and I agree to a certain extent. There are some times when that is the case, like if you get the run-ups in, let's say, oil that you had a couple of years ago, or commodities in general a couple of years ago when the hedge funds were buying and making kind of a big bull market situation. There are times when you do want to let it run, but in more recent times, it seems like the market is a little bit more choppy, back and forth, ranging within, it's volatile, but still it ranges back and forth. And so the trends that are there are, sometimes they're good. You don't know when it's going to be, but sometimes they're not there. And so on the side of caution, I'd like to be able to put a little bit in my pocket and trade with the market's money if I have a choice, as opposed to going, just trying to hang on for the last dollar and eke all the profit out that I possibly can. Now, in this case, I mentioned we were at 1133. We hit that one. We almost got knocked out in this case right here, where you can see that the market extended below the predicted lows. Should have mentioned, as I said before, that when we get into a market, the first thing you want to do is you want to set a stop that you can live with. If I got into the market, I probably would set a stop at the predicted high because I don't want to risk more than $10, or in the full-size contract that would be $500. I don't want to risk more than that with my little account, so I have to be a little bit careful. Then I'm going to, after I get a little bit of movement and the market moves up, I'm going to keep a trailing stop below the predicted next day low as long as I can, have that above my entry point so that I'm not jeopardizing the profits that I have. Now, the next possible point that I talked about, if we're talking about the $20 increments at which we're going to try to trade, take our profits, is going to be in the vicinity of 1153. Now, these probably aren't exactly perfect. I can't see exactly on my screen exactly where these things line up, but at 1153, you'd have a profit, in this case, with this contract of $4,000. So now you have two trades, three contracts. Out of three contracts, you have two contracts which you have made some money, and so you're ahead. The next target would be, $20 beyond that, 1173. But sometimes with that third target, as long as you have pocketed some of the market's money, would be to kind of let that ride a little bit, or just to see where the market might take you. So you may not want to set a stop out point with that at 1173. You might want to let the market work out a little bit and see where the possibilities might go. In this case, we had the situation where the market did, go up beyond there, got our two contracts for profit, but then we started to hit kind of a down point here. We started to have, as you can see down here below here, the predicted differences turning down, change in situation with the neural index dropping to 0. So there were some bearish factors that were starting to shape up here. And in this case, the stop out point would have been right here. We're talking about the market having reached a predicted low in this particular case here at 1134. So this would stop us out at 1124 roughly on one of these 2 days. I'm not sure exactly which day you might have got out because this was a very close to being 1124 right here. But at some point right in here, you would have been out at 1124. I know that's not your 1173. It's a little bit short of that target, but still in this third contract, you had a profit of $1,100 from where you got in. So you put those three contracts together, the full-size contracts, and you would have a profit of $7,100, which isn't too bad for a short-term trade. Again, probably risking maybe a little bit more than you'd like to risk, but with you small accounts, you'd have to take a little bit more of a chance and try to find out, where, at what point are you going to have to get out? What can you tolerate in terms of your risk propensity? Now we're going ahead a little bit, skip ahead. We have a situation right here where the market starts to move down. We had the predicted high. I should have pointed out right here, we should have a predicted high on this particular day. Now this depends if you're really smart and you really assume the market is going to go down based on the indicators that I pointed down here below, where you have your differences moving down, your neural index at 0 and so forth. If you're really confident that it could go down, you could say, okay, I am going to fade this predicted high, and the predicted high was at 1144. And the actual high was something like 1142. So you could put a stop, depending again, a limit order rather, somewhere in the vicinity 1141, 1142 or whatever. And if it gets above there, go short and ride the market down. Obviously, you don't know if that's what's going to happen or not because, this is a situation where it did meet the high. It is for active traders only to trade this type of a signal. But, may not be your style. I'm not sure. I'm not going to speak to you, but you can determine exactly what you're going to do when you trade. Now, we talked about this high, the predicted low, rather, right in here, 1134. And so you're going to be selling at 1124. When you get in at 1124, again, we put a little line right here, 1124, approximately where you're in. Now you have another set of targets that you can put in. You're going to put in the first target. Your first profit objective is going to be at 1104. Probably going to get you out on the same day if it slides down that far. Then you have the next target at 1084. Again, trying to line up this where we might have to go here or here. I'm not quite sure. I can't really read on here, but in other words, when you get that opportunity to cash out, it's not nobody can go broke taking a profit, they say, and I know you're supposed to let trends run and let the profits run, but in the current market conditions, those are the types of things that you have to kind of think your way through and what you can take. So my preference would be, if I see these kind of situations, I'd take a little bit of profit if I can off the table before it disappears. So after the market comes on down, you're going to be in a situation, you're riding the market short. You still have that one contract left of the three. You have a predicted high right here where the market is starting to turn back around. As you note on the bottom with the differences, those lines are starting to turn up. You have the neural index is at 1. All those indicators are corroborating each other, suggesting that this is more of a stronger market, a market that's tending to go higher. So you're going to, on this particular date right here, you have this predicted high, and you're going to try to place a stop somewhere at $10 above that. The predicted high was 1107, and so your out point is going to be something around 1107, somewhere around 1117, somewhere around that. That would get you out of this other trade. Now, the next thing you might want to do is you might want to jump right back in, because the gold bugs and so forth are talking about the market going higher. So you have a situation here where you may want to ride an uptrend. The market starts to turn here. You have a predicted high here of 1107. I misspoke on the previous one. The amount really that where you got out was at 1099. So this one here is where you had the predicted high at 1107, and so that means that you are going to be a buyer at 1117 in here. Again, as I said, sometimes things work, sometimes they don't. In this particular case, it didn't work so good, so you'd want to keep your stop somewhere around the point of entry where you got in, and in case that market turns around, again, depends on how much risk you can tolerate, but you want to keep your risk small, make the loss small. In this case, you would have probably gotten stopped out if you are using 10 points as your criteria with a $500 loss. But that's not too bad, considering that the previous two trades that we talked about, the two series of 3 contract trades, would have returned something like 15,000. Now we have a situation where the market again starts to turn back down. You have the predicted low here at 1105. That means you're going to put your stop in here to sell 1095. You're going to set your targets up, and hopefully, you're looking for them to get hit. You have 1075. You have it get hit here, so you have one contract where you have the money in the bank in your pocket. Then the second one is at 1055, and that happens the next day. So you have a couple of contracts where you've made some money. Again, this is 2,000 for the first one, 4,000 for the second one, and then you still have that third contract to play with if it would go on further. In some cases, obviously, the market's going to turn before you get there, and so you're going to have to get out, more quickly than market does start to turn around, you'll be out. The predicted high there was at 1069, so you would be out at 1079. Whether that would get you out of the market, it would get you out of the market, but whether that's as much profit as you want, up to you, but that's a nice profit on this third contract of $1,600. So again, you have another series of trades that you have made that have turned out to be highly profitable. Well, now we get to the current time. As I said, we are out of the market. We found the particular trade there. Now we have a situation where the predicted high, because we have some indications here that the trend is kind of tilting to the upside. We have the differences moving up a little bit. We have the neural index at 1, and so you have a predicted high at 1082. That means you are going to put your stop to get into this market long at 1092. So when you get in at 1092, you start setting up your targets. The first one at 1112, somewhere right in there, and then you have your other targets, 1132, so forth, all the way up. You can line them up if you wish. And if you are following the market at all today, you know that when the market broke out of the holiday period, came back from the holiday very strong, and did shoot up through those particular target, that first target anyway. So you have, in this case, your current status is one contract you have gotten the profits on of $2,000. You have a second contract that so far is surplus, not stopped out yet, and a third contract that you can use then to let the market ride higher if it wants to ride higher. So you're kind of following the trend. At the same time, you're taking some profits along the way because you don't know for sure, if this trend is going to materialize, and you don't want to lose out on it if it's a situation where that market does start to turn around and take away some of that money that you worked so hard to get. Now we're going to go back to some of the some other markets and look at some other charts back at the gold market here, but we're going to look at a couple of others. Now, I can't look at all the various markets, but I'm going to look at a couple of the popular ones. The first one I'm going to look at is the E-mini. As you know, the E-mini is probably the most popular contract for traders. It's a very active contract, very liquid contract, so a lot of people look at it every day as a gauge of what is going on in the stock market. Again, we aren't going to be able to look at every single item here, but we'll look at a couple of things that potentially would be indications of where to trade. First of all, in the market, let's cut back over here. Let's take a picture of this and make a few comments about that as to where we would get in, where we would get out, and how we would trade the breakouts of the trend. When we look at the markets here, we are also looking at the possibility of getting caught. So again, we are always looking at the possibility of the risk factor. Always keep that in mind. In this case right here, on this particular situation right here, we would be out of that previous trade where we rode the trade up and it would have come out there. So we would be kind of sitting here sideways until we come to a point in time on, I think it was January 21st, where this breakout started to occur. And we had on that particular day, that was on January 20th, we had the predicted low of 1138, so that would make your target at 1128. Again, the same type of thing that we did before. If you have a target at 1128, you're going to be short right in here somewhere, and you are going to be collecting some, excuse me, I should take that one away. So we're going to sell at 1128, and that particular point is roughly right in here. And then we're going to help ride that down, and we're going to set our targets at 1108, and 1108 occurs about right in here, and then we're going to ride it down 1088 and set a target right here of 1068. Now we can also, as I mentioned before, we can determine if we want to take this profit at 1068 or if we want to ride it a little bit further. But if you took it with the three contract situation, you have pocketed a pretty nice chunk of change if you ride the E-mini down this far. Again, after the market has moved down and you are short, on this candle right here, you have the predicted high of right there at that particular high. You have a predicted high, and that's at 1084. So at plus 10 at 1094, you're going to get out of that contract, and then you're going to be sitting flat on this contract. You're going to be out of the market. After this trade, the market then does turn back around again. We have it's the type of thing you have to watch this every day. Kind of download your data every day, kind of make your decisions, make your plans, your trades, as to what can happen. On this particular day, we had the predicted low of 1088, so we have our selling target at somewhere around 1078, somewhere right in there, and we're going to then set our target 1058, and I believe 1038, and I believe we did just barely catch that with that second one. But then the third contract, as we happened before, we would probably have to keep our stop above this predicted high right here, and would probably have gotten stopped out somewhere in the vicinity here where we would have gotten out of the market and now be kind of sitting sideways, depending on what to do. Now, it depends, again, a little bit on how you view the longer-term picture and the shorter-term picture. There's a possibility that in this case where you could have a breakout either side of the range, you could trade, on a contingency basis, buy on the breakout on the upside or the downside, whichever, using the other breakout as a stop. Again, the range here is fairly wide. You can see it's getting close to 20 points, and 20 points is maybe a fairly hefty size of risk for you to take. 20 points actually plus the 10 points that I mentioned leeway on either side. So where you place your stops and so forth will depend upon how much risk you can tolerate and what you want to think. I will point out that when you look at what is going on in the market currently, what it looks like is that shape heading up going into today, and today was, at this point anyway, was a fairly strong move the last I saw, but we had the predicted differences pointing up. We had the neuro index at 1, so that would suggest that your odds, your probability would favor being on the long side for a breakout for this particular market. I'm going to switch back over here to our Vantage Point screen, talk about a couple of other markets, and kind of do a quicker analysis of them and see what would happen with the breakout situation if we were to trade with that particular type of a strategy. The next market that we're going to look at, the euro. Euro, very popular currency to trade, as you know. There's a great deal of discussion about the value of the U.S. dollar, and the euro is kind of the counterpart, or the contra dollar, or whatever you want to call it, because it's a mirror image of what the dollar does. So what the dollar does, what the euro does, those are very important gauges of what the whole commodity market situation might do, simply because as the dollar gets higher, the likelihood of other commodities being under pressure is increased. So that's why the currency should be a factor in any market that you trade, and one of those that you need to watch. On the euro, we'll not go through the whole point here of showing all the trades, but you'll see right where the cursor is right now that was a good breakout situation for the euro. The predicted low was at 144.48 that particular day, and so that meant you would have been into the market. You would have been making a trade at 143.48. Again, that's a full 100 points, 100 pips. You may have another guideline that you want to do depending upon how much risk you're willing to take, and kind of like you have to watch the market, you have to watch what the previous range has been, daily range, and then use that as a guide in setting up where you might possibly want to, how much you want to allow the market to move up and above the predicted high or below the predicted low. In this particular case, we had the euro trending all the way down until you get to this white candle down here towards the bottom. We start to get a little bit of a turn in the situation, a bottoming situation, and we had the predicted high exceeded by the full 100 pips, and so you would have been out of the market, and again you'd be sitting there on the sidelines. You potentially could have gotten short. If you'll see here where this predicted low was, where the cursor is, you potentially could have gotten short at 100 pips below that point on this particular candle right here. But if you look at it from the standpoint of where the next possible move is, you're probably going to be looking at some kind of a move above the predicted high as an entry situation. No good signals yet from the predicted differences or from the neural index or anything. We need another day of trading, and of course we have it by now, but at the time I made this chart, going into the week or after the weekend and the holiday, that's what it looked like. You would need another little boost of trading if you were to keep a stop above the predicted high for that to be reached. One final market that we're going to take a look at to see kind of how it looks, because it's a popular one also, and that is soybeans. The soybean market is a favorite in terms of speculators because it has quite a bit of movement and sometimes fairly volatile movement. If you go back, in time, you'll know that in the case of soybeans, there's kind of a contra-seasonal move in the fall. Then we have a situation that has been dubbed as, probably if you've traded grains at all, you know about the February break, the so-called February break that occurs every year in the early part of the year. And so that's kind of what the market has been going through recently. But stepping back a little bit just to take a look at some of the movements in the soybean market and what has occurred. The first thing that you'll note is that we have a situation back a ways here where you had the predicted high. of, let's see, what we have 10.08. So that means that, again, I'm using 10 cents here as my point of leeway simply because 10 cents equals $500 in a full-size soybean contract. I like $500 is willing to take, but that's kind of where I'm at. So that means with the high at 10.08, I am going to be into this market if I can get in at 10.18. So I'm going to set my targets. I'm going to, do my 10.38 is going to be my first target because I want to take my 10 cents and find it somewhere right in there. 10.58. Again, I believe I hit that one right in here somewhere, 10.58. So the first two contracts did produce some money, some profits, some nice profits. But then there always comes that time when the situation starts to change. When you notice the turnover, the crossover of the predicted differences, you have the turn down in the neural index where things start to look a little weak. And so you have to be prepared for that turn in the market, which occurred right here. And so you're going to have a stop below that predicted low. The predicted low was, it's where you were stopped out at 1042 minus 10. 1042 was your predicted low, minus 10, so you'd be stopped out at 1032. So even though you didn't make as much money on this trade, still not too bad because, any trade that comes up with the profit always is a good trade. Then after you watch the market, now you're out of the market, you're sitting there a little bit sideways, you're kind of wondering what's the next step going to be. You may not have waited here, you may have jumped in, a little bit, trying to jump in, anticipate what the market is going to do, but you come into a point right here where you have the market making a predicted low on January 12th of 9.94, so you minus your 10 cents from there, and you're going to be into the market at 9.84. I said 9.94 was a predicted low, but 9.84 is where you're going to be short the market. One of the nice features about this is that when you're looking at charts, you never want to overlook the potential moves that other people are looking at. And a lot of traders, when they look at the traditional technical analysis, they're going to be looking at this low that I mentioned before, which is a breakout of that low is indicated as a spot where they might go short. So you have to be aware of what other people might be thinking. When that coincides with the low that we have projected here by the penetration of the predicted low, pretty good sign that you could have a market that could go lower, which is, of course, what has happened here. The most recent situation, of course, is that the market has tended to turn a little bit. We have a situation where the predicted differences are moving up, not hugely, but they're moving up. The predicted neural index is at 1, which is a bullish situation. So the odds are pretty good. If you were trading this particular market, you would have gotten stopped out somewhere right in here above that predicted high on this candle right here, because once you set that predicted high at the lowest predicted high, you don't want to be moving your stop up and down, back and forth, but you want to maintain it right there and get out, take what you can get for the profits and not take a chance of playing with the market. Now the next possible trade that you would have had here in the situation you would probably be in today is that if you were looking at the situation with the predicted high here, you would have probably gone long, could have gone long on this situation right here at 10 cents above the market, and you would now be long, even though it seems maybe a little bit, not the type of thing intuitively you might do, but you might be long soybeans right here. You possibly, depending, I didn't measure this out, it might have been enough to knock you out of the market with a small loss, but the position now, if you're in soybeans, would probably be on the long side unless the market tells you something different. You don't try to anticipate, you don't try to guess what the market is going to tell you, but you kind of let the market come to you and tell you what it wants to do, because there's no way you are going to tell the market what it ought to be doing. Just to look back a little bit, review some of the situations that we have with the breakout type of trading. Mentioned before, when you look at breakouts, and consider the breakout situations, you have to remember that breakouts can be very subjective. Where's that trend line? Where's the high? Where's the low? All of those kind of things are kind of things where you have to sit and look and observe and so forth, so that can lead to some fairly subjective types of decisions, and not every trader is going to make the same decision. That's part of what makes markets. As I mentioned, when I use the vantage point indicators, the predicted highs and lows to set up a channel that I use, which is different than the pivot points or a lot of other channels that other people might use. But I like to have some kind of support, some kind of a confirmation from other indicators, and the predicted moving averages, the predicted differences, all of those kind of things. They provide the alerts that you might have a potential breakout shaping up. Again, you don't anticipate, but you kind of be prepared for them when they do happen. Also, I mentioned the multiple contract positions. That way, if you have a possible type of situation where the market is moving, and if you want to stay with it, you can stay with it. If you have only one contract, it's either kind of an all or nothing. So that's why, if you have a choice, I guess my size account would prefer to trade the mini contracts and trade several of them as opposed to one large size contract, because that would give me more flexibility of where to get in and where to get out of a trade. Now, a couple of other things here just to get some feedback from you. I use gold as an example market today for the most part, showing you kind of the breakout type of strategy. And the original question that I wanted to ask, that I have everybody talk about, is what would be your opinion as to whether the market would be a breakout to the upside or the downside? And today's action kind of determined that. It broke out to the upside already, so I guess by preparing it on a day after a holiday, sometimes those kinds of things happen. So that kind of makes it a moot point, because it did break out to the upside. So now the question is, I want you to look at that little man again, and if you agree, you can say, I agree. But the question here is, or the statement is, I believe the upside breakout will reach the January 11th high of 1163. If you agree that the gold market is going to move on up, reach the January high of 1163, click on I agree. If you think gold is doomed and is headed lower, some people talk about gold and commodities and everything going lower because of the pressure that we'll get from the U.S. dollar. You're not going to agree, but do you agree is the breakout will reach the January 11th high? Okay, I see we're seeing some disagreement. So some people don't think that the gold market, the rally that is coming out of here, has legs. Some people do, which I guess we don't really have a consensus here, but a little bit of an edge that the gold market will not reach the 1163 January 11th high. That's what makes markets. Everybody has an opinion, and everybody expresses their opinion in the way that they trade. Now you'll see the information, the contact information on the screen. If you're interested in more about Vantage Point and what it can do, you need to contact those numbers. If I can answer any questions about the markets that I've talked about, or any other markets, give some opinions, I will try to do that, or any opinions about breakout type of trading. But if you have Vantage Point types of questions, you'll see the information there, and Darla will talk to you about the click here feature there in a little bit. So if you have any questions, fire away. I'll take a few that I can in the limited amount of time that is available. See what we can come up with. Any questions? Okay, not seeing any questions, so I've either baffled you or answered every question you ever had. Again, as I said, it's a breakout strategy, is something that can be applied to any market. A lot of different types of technical analysis indicators, like trend lines or highs, lows, whatever you care. My preference is to use or develop some kind of a channel, a predicted highs and lows from Vantage Point, which I have found more useful than trying to predict or suggest where that trend line ought to be. So that's why I showed you the examples using Vantage Point with the predicted highs and lows. Well, I am seeing no questions, and so I think what I will do is I will turn this back to Darla. Thank you for attending. We have several other webinars coming up over the next few months, and some are strategy-oriented, some of them are market-oriented, and we hope you'll be with us for those webinars. As it's kind of the end of my time today, I'd just like to thank you for attending this webinar. Look forward to seeing you at future webinars. Back to you, Darla.
Thank you, Daryl. Our audience can do a very small gesture in thanking Daryl for the presentation. On the drop-down menu where you were choosing agree and disagree, you do have an applause option there. We really thank him for spending some time with us today. Now, you'll find today's webcast on Trader Planet later this afternoon, and we have made arrangements to email the link to everyone in this audience. If you are interested in seeking further information on VantagePoint Intermarket Analysis software, just select the Click Here link on this final slide. This will place a request with our friends at Market Technologies for free market forecasts and additional information on their trading software that Daryl has featured in this presentation. This concludes today's webinar session. Thank you for attending, and all of us here at Trader Planet wish you a pleasant evening.